you. Welcome to my YouTube channel. So if you haven't done so already, please go ahead, like, share, and subscribe, right? So in this video, we're talking about what is an order block and why is it important. So let's just get right straight to it. So basically, an order block, it is defined as the last up move or down move before price broke structure to the downside or to the upside, right? Some people call the order blocks supply and demand zones. You hear people saying, okay, it's a supply, there's a demand. That would actually be referring to order blocks, right? So why is an order block so important? It's because it provides for traders perfect entry opportunities to enter the market and make money, because eventually price will needs to return to order blocks, right, to close what sacrificed capital. So it eventually need to return to the order block. So if you know an order block and how to identify them correctly, you'd be able to make so much informed decisions in the market. So, but however, before I'm to explain the more on order block, what it is, and show you real chart examples what it is, I want us to look at this, right? I want to explain what I said when I said the last up move, right? The last up move or down move, right? Before price broke structure to the upside. Okay, so if here we've got a chart, and in this chart we have got two things. There's this thing that I written here that is called break of structure, right? So this, if the market is like this, is an uptrend. It's going up, creating series of higher highs and higher lows, right? If it's like this, it's a what? A downtrend, creating series of lower highs and lower lows, right? So if the market goes up, right, and comes down and goes up again to break this high, the previous high, so to surpass that high, we call that a break of structure, right? It has broken this structure, that is this higher high. The same here, it happened, and then break of what? Of structure. So the market broke what? The last higher high. So this is for an uptrend. However, for a downtrend, the market has to break the last lower low. Why? Because it's moving in a downtrend. So it goes down, up, down, right? So if it breaks this zone here, we call it what? And we call that the break of structure, right? Break of structure, because it broke this or this low. Then same thing goes up, comes down, break of structure because it broke this low. That's what we are seeing here when we're saying break of structure, right? So break of structure happens, and each and every time when a break of structure, when the market moves up, right? This is, let's say for example, this is an uptrend, and the market goes up, it will come down, and when it's coming down, we call this retracement. It's retracing mostly to a zone of an order block. So chances are there'll be an order block here. The same thing that the market did here and comes back, chances are there's an order block here. So if you understand the order blocks and how to identify them correctly, you'd be able to enter at spots here and make all these pips make a lot of money. And another thing is when the market changes direction, like for example, you see, let's say for example, this uptrend, right? We're making higher highs, higher lows, higher highs, higher lows, and you're seeing that these lows are not breaking. The price is not close, they're not breaking one another, right? Price is just going up, 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 right? But however, here price went down, up, causing break of structure. All of a sudden, came back down, breaking this low, the previous low, right? So this is not supposed to happen in an uptrend. However, if it happens like this, it means that the market is telling you that I'm now changing direction from being an uptrend into being a what? A downtrend. And if it happens in a downtrend, it's the market telling you that what? I'm now changing direction from being a what? A downtrend into being a what? An uptrend, which means that if this happens, you have to know the order blocks that are here so that you can capitalize on them, enter, and make money all together there. So let's just look, for example, in what it might look like in a row chart example. We have got this thing here, right? Look at this. The market went up here, right? Came down. I think breaking this what? Breaking this low. So chances are this was a downtrend, right? So breaking this low, or it was a downtrend, an uptrend, whatever it was, and then came down here, right, made a swing, right, and then went up. So remember when I said swing, just like what you did in the last video, right, went down, see, up. You see, that's what is happening here. Down, up, right. So swing, up. See, swing, up. So where is it going? Where is it going? It's going to mitigate a what? An order block. So if the order, let's say for example, if it was downtrend, so swing, down, swing, order block somewhere here, right? So look at this. Where was the order block? Swing, right? And then up for retracement. Retracing coming where? Look, this green bar. Seeing this green bar? They've got this green bar, right? Don't worry about this one. Yes, it's also an order block, but actually it doesn't meet the proper rules, but it's also an order block. So we've got this one, the last up move. Remember the definition, the last up move, right? So here I am where I am in a downtrend. So the last up move before the down move that broke structure. So this green candle before this bearish move, these bearish candles that then broke structure here. So we've got this order block, and we've got this one also. The last, this is another green move before this one that then broke what? So we've got this order block and this order block. So the market, when it came here, it went back up to mitigate this order block and this order block before it actually drops. Then you sell there. You see, then you capitalize and actually make money. And then when that happens now, for example, if you're on a downtrend and you enter here, let's say because of an order block, you sell here, then you take your profit. Your TP1 should be at least here by the break of structure, right? By the last lower low. This is why you see here, I said what? I said when it went up, then I said what? Take profit here. Take profit here on the last lower low. And then let me just show you also another example in another chart. Here's another chart. So if you have to look at this chart, it looks like it's a bit complex, but also it's a downtrend also. Market went up, right? Then down, right? Then up, down, up, down. So if you had noticed here, right, something happened. So it went down, right, and then breaking what? This structure. So most probably this was what? This was a change of character that happened here. This market was highly likely an uptrend previously, and then creating this higher high, higher low, higher high, all of a sudden came and broke this what? This higher low, and then it had now to go back and retrace to this order block. We've got this order block here. If you have to zoom here for somebody, so Mishek, you said what? The last up move, that is the last bullish move before the down move that broke structure, right? Or you can say the last what? The down move before the up move that broke structure, depending, are you in an uptrend or you're in a downtrend. So if you have to zoom this candle here, this is what we call a hidden order block, right? If you had to zoom it, you notice that in the, maybe if this was, let's say, 1 hour time frame, in the 30 minutes time frame or 15 minute time frame, this would be really a bearish what candle. So the market came and then mitigated this one and then went down. However, with another order block, like you see this one, this candle here, the last also what up move, bullish move before this major down move that broke structure with another one, right? So if you see that we've got two order blocks, like here with an order block and here with an order block, the first order block will highly likely be used as inducement by the market. So do not trust it. This is why you see here it was respected, right? And people entered here and then it went down. All of a sudden it came back up, took all the people it entered out, right? And mitigated the last what? This order block. So if you're in a situation where, let's say, you're in a downtrend and then you've got two order blocks, always use the one that is above the other, right? That's the most reliable one. So let me also then take you to I think the same thing also happened here. Like for example, when this order block was mitigated, the market came down, broke structure here, right? Broke structure, and then retraced up to mitigate what? This order block, this green candle before this major red candle that broke structure to the downside, right? Right, and then the thing continues and continues. So you could have entered here, you could have entered here, and you'd have made money. So there are just about 3 rules for order blocks that you have to keep in mind. The first rule is that there must always be a break of structure, right? So there must always be a breakout structure, either the upside or to the downside, right? So if there is no breakout structure, it means it's not a valid what? It's not an order block. Because for it to be an order block, there must be what? A breakout structure. This is why I said an order block is the last up move or down move before price broke structure, which means if there was no breakout structure, it means that there is no order block. To take you back, remember what we said breakout structure is: the market goes up in an uptrend and then it breaks the last high. That's breakout structure, and then what? Breakout structure. If it is a downtrend, it's going down, breaking the last low. That's what? Breakout structure. So there must be some level of breakout structure for the order block to be verified as a true order block. Secondly, there must be higher volume at the order block, right? There must be higher volume. What do I mean by higher volume? Look at these two examples that I gave. So look at this red candle. This is this drop, red candle, right? With 1, 2. There are two big candles, very big candles. Just compare them to the others. These are small. This one, boom. It's a big candle, right? It's what you call that higher volume. That's what we refer to when we say there must be higher volume. That is, this order block, this green candle is followed by this major down move. That is this candle that has got what? Higher volume to the downside. The same also here, this order block, this red move, that bearish move that went down, higher volume. Are you seeing that? Right. So there must be higher volume. And then thirdly, the order block must not be mitigated. So I'll show you two examples. What we call by mitigation, right? What do you call by mitigation? Let's look, for example, firstly in this chart, we had this order block and with these order blocks. And if you hear me properly, I said what? Yes, we mustn't track these order blocks, especially this one. Look at this one, this green candlestick here, right? And then with the red candlestick. And then what we mean by what? It must not be mitigated. Look at the third one that followed right after this red one. The wick close, it came and touched what? An area that this green had touched before. This is what we call mitigation, right? Look at this one also. We've got the red here, we've got green here, we've got the red, right? And then look at this wick, this candlestick wick. It touched an area that aligns to this green candle, right? This is what we call mitigation. So if it's like that, yes, it can work, but it mustn't be trusted. Look at this, for example, right? This one, it had what? We had green move and then major down move to the downside. And the third one, this is the third candle, right? It didn't come and retest an area somewhere here aligning to this green candle, right? So which means that this order block wasn't mitigated. This is why you see also it's a valid order block. So it mustn't be mitigated. And then, so remember, let's just recap. We said for an order block to be the order block, three order block rules that we must keep in mind. There must always be a breakout structure. Secondly, there must be higher volume at the order block. Thirdly, the order block must not be mitigated, right? So if the order block is not mitigated, for example, like this one, this zone where the order block, which the price will then have to then mitigate, we call this zone imbalance, right? That's imbalance. It's a gap here, imbalance, right? That is still to be filled by market, so that this one can be mitigated. So basically, in a nutshell, that's it about order blocks. I hope you have learned. Understand more on what order blocks are. If you can even rewatch this video and let it sink in your head. It will actually assist you to make more informed decisions in the market. So thank you so much. Once again, do not forget to like, share, and subscribe.